Welcome to our video on options trading strategies during earnings season. Earnings season can be a volatile time for the stock market, but there are strategies you can use to take advantage of the increased volatility. In this video, we'll cover top 4 option strategies that you can use during earnings season to potentially profit from the market's movements. 1. Straddle strategy. The first strategy we'll cover is the straddle strategy. This is a neutral strategy that involves buying both a call option and a put option at the same strike price and expiration date. This strategy profits if there is a large move in either direction after the earnings announcement. Suppose XYZ company announces its earnings report tomorrow, and you believe the stock price will move significantly. You can purchase a straddle option by buying both a call option and a put option at the same strike price and expiration date. If the stock price moves significantly up or down, you'll profit from the option that is in the money. 2. Strangle strategy. The second strategy we'll cover is the strangle strategy. This is a similar strategy to the straddle, but the call and put options are purchased at different strike prices. The goal is to profit from a large move in either direction, but the trader is willing to accept a smaller profit potential for a lower overall cost of the trade. Let's look at an example. Suppose ABC company announces its earnings report next week, and you believe the stock price will move significantly, but you're not sure which direction it will move. You can purchase a strangle option by buying both a call option and a put option at different strike prices. If the stock price moves significantly up or down, you'll profit from the option that is in the money. 3. Call or put spreads. The third strategy we'll cover is call or put spreads. This involves buying or selling either call or put options and selling or buying the same type of option at a different strike price. The goal is to limit the potential loss and also take advantage of a move in the stock price after the earnings announcement. If DEF company announces its earnings report next month and you believe the stock price will move slightly, but you're not sure in which direction, you can purchase a call or put spread option by buying or selling a call or put option and selling or buying the same type of option at a different strike price. This strategy will limit your potential loss and give you a chance to profit if the stock price moves in your favor. 4. Iron butterfly strategy. The fourth strategy we'll cover is the iron butterfly strategy. This is a complex option strategy that involves selling and buying both call and put options at different strike prices to generate income. This strategy can be used during earnings season to take advantage of the increased volatility. Let's say today GHI company announces its earnings report next week, and you believe the stock price will remain relatively stable. You can use the iron butterfly strategy by selling both a call option and a put option at the current stock price, and buying both a call option and a put option at a higher and lower strike price. This strategy will generate income if the stock price remains stable. It's important to keep in mind that earnings season can be a volatile period, and options prices can be more expensive, so it's important to thoroughly understand the underlying stock, the company's financials, and the expected earnings announcement before entering into any trades. That's all for today's video on option strategies for earnings. We hope you found these strategies helpful and informative. As always, please remember to do your own research before making any investment decisions. Don't forget to like and subscribe to our channel for more investment tips and strategies. Thank you for watching, and we'll see you in the next video.